All right, listen up. Welcome to today's Explainer. I'm Steve. Grab a seat and settle in because we are opening up the red folder today. The market action over the last 24 hours? Well, it hasn't just been volatile. It's been a literal masterclass in multi-asset divergence. We're talking assets violently ripping in completely opposite directions. Look, if you thought yesterday's hawkish Fed meeting was going to permanently break the back of this bull market, today's tape just handed the bears a massive structural reality check. We're in the war room today, guys. We're breaking down exactly how these capital flows rotated and why the primary trends are defiantly holding their ground.
So here's the million-dollar question that had retail absolutely panicking at the open. The Fed went hawkish, so why is the bull market surviving? It's the central mystery we're solving right now. Look, the Federal Reserve held rates steady, right? But they signaled a distinctly more restrictive, higher-for-longer outlook. Naturally, automated desks went into immediate defense mode, de-risking across the board. But then, equities completely reversed. Why? Because we've got an incredible multi-asset tug-of-war going on. Structural relief from macro energy deflation just stepped into the ring, and I'll tell you, it is completely flattening the central bank's restrictive narrative.
I want you to look straight at the scoreboard here. This is our daily market performance dashboard, and the algorithmic response today was clean, it was aggressive, and highly instructive. Look at this. We've got the S&P catching a massive geopolitical short squeeze. Brent crude, it's stabilizing its curve. But then, on the flip side, gold and Bitcoin took heavy technical damage from the Fed's liquidation shockwaves. Basically, forced selling triggered by that restrictive outlook. The numbers on the board right now show a market that is violently separating the winners from the losers based on raw, underlying fundamentals.
Section 1. The scoreboard rebound. Active terminal lock.
Let's break down the specific terminal prints that define today's session, because the algorithmic footprint here is just undeniable. 75.77. After flushing hard on that initial Fed statement, September S&P futures staged a massive mechanical counteroffensive. Equity bulls utilized that broader macro relief to spark a squeeze, driving the index aggressively higher. And look, reclaiming this level, it's not just some minor victory. It means the index is actively reclaiming its intermediate moving averages, a crystal clear signal that the medium-term uptrend is safe. It locks in a true terminal print, which is that final, definitive price level that algorithms anchor to.
Meanwhile, over in the metals pit, August gold took an absolute beating. 42.36. Honestly, this was a brutal programmatic punch. Gold cascaded down over 2% today. The asset took a systemic hit, effectively bleeding out its entire recent premium as those algos just ripped right through technical support levels.
And rounding out the major prints, we've got the active June Bitcoin contract holding at 63,200. The digital asset space just couldn't escape the macro drag, and what we saw was textbook systematic leverage reduction. The hot money got trimmed out, sliding the contract down to anchor right at this critical defensive shelf, that key price level where buyers finally step up to stop the bleeding.
Section 2. The energy deflation catalyst. Behind the geopolitical curtain.
So, to really understand why equities are just completely ignoring a hawkish central bank while metals and crypto bleed out, we gotta look directly at the energy pits. While the active September Brent crude contract managed to hold technical structure right at the $91 mark, man, that is only half the story. The broader physical spot market is pricing in an absolute meltdown in the geopolitical war premium. And here's the specific fundamental catalyst driving that shift. The official details of a U.S.-Iran interim peace framework hit the wires today. This isn't just standard diplomatic noise. It includes a concrete 14-point memorandum that literally guarantees fee-free transit. For institutional models, the formalization of this deal translates instantly into an immediate long-term corporate tax cut by way of energy cost deflation.
The mechanics of this timeline are absolutely crucial for the smart money. Check this out. Day 0. The memo is signed. Boom. Within 30 days, we see a complete restoration of shipping capacity straight through the Strait of Hormuz. And by day 60, the negotiation period officially wraps up. The exact moment this guaranteed free transit timeline was modeled, institutional trading desks across the street instantly dropped their long-term energy forecasts. And here's exactly how that macro shift translates directly into equity performance. It's a clean 3-step sequence. Step 1, lower forward energy assumptions get priced in. Step 2, this rapidly deflates transport, manufacturing, and shipping inputs across the entire board. Step 3, that directly expands corporate profit margins. For our equity charts, guys, this sequence is pure nitro. It completely 100% offsets the Federal Reserve's higher-for-longer interest rate headwinds.
Section 3. Gold's post-Fed liquidation, yield surge, and premium extraction. Let's track the action over at the metals desk now. Gold is telling a highly cautionary, honestly brutal story right now about risk premium extraction and exactly what happens when leveraged speculators get caught off guard by rising real yields. Ahead of the Fed, gold spiked on all that geopolitical panic. But today, the hawkish dot plot dropped the hammer. Look at this dynamic. On one side, you've got a central bank tape keeping the door open to an additional rate increase, which obviously drives up real yields. On the flip side, you have non-yielding bullion. As yields rise, the opportunity cost of holding a non-yielding asset just surges. The algorithms did the math, they ruthlessly flushed the tape and forced gold to shed its war premium and reground itself in fixed income realities.
Section 4. Crypto's leverage trim. The post-Fed macro drag.
Now, while big money flooded back into large-cap equity curves to ride that energy relief, the crypto desks had to absorb a distinct heavy pocket of selling. We really need to dissect this post-Fed macro drag. Hot money actively stepped away from centralized crypto infrastructure today. Why? To seek safety in those highly liquid index curves. Digital assets are currently facing a massive dual headwind. First, you've got the systematic leverage trimming driven directly by the Fed's restrictive, higher-for-longer tone. But compounding that, the digital tape is working through fresh reports of central bank pressure in Europe, actively stalling major exchange licensing applications. When you combine macro tightening from the Fed with that kind of regulatory friction, capital just flows out, seeking the fundamental safety of the equity market's newly found energy tax cut.
Section 5. Professional Trading Directives. The Risk Management Blueprint.
All right, we've diagnosed the flows. So, how do we actually manage our risk and execute like professionals in this fragmented environment? Here are your marching orders. Listen closely. First, stop chasing the macro headlines. Seriously, let the hard technical levels dictate your position sizing. Second, the S&P put in a decisive bounce off its short-term 20-day simple moving average today. But the real line in the sand is the 50-day exponential moving average, that longer-term trend line. As long as that 50-day holds on a weekly closing basis, the primary bull engine remains entirely intact. Third, keep your eyes pinned to that Brent curve. If the war premium keeps dropping, the runway is totally clear for equity upside, regardless of what the Fed says. And finally, protect your cash on the crypto side. Keep your sizing strictly defensive until a firm bottom actually prints. Let the levels do the heavy lifting.
Look, this market is highly technical and utterly ruthless to anybody who ignores the structural flows. We've laid out the data, we've tracked the rotation, and we've set the parameters. The ledger is open, and the numbers never lie. The only question left to answer is, are you ready for the morning bell? Stay disciplined, manage your risk, and I'll catch you on the next explainer.